China's cash crisis is threatening to trigger a liquidity trap. I'm your host, Steven Van Metre, and thanks for joining me today. And things in China continue to go from bad to worse, with the latest problem focused on its banking system that is threatening to trigger a liquidity trap. Let's head over to Bloomberg, where we picked today's story up with the headline: the Chinese banks overflow with cash that nobody wants to borrow, as COVID uncertainty means borrowers reluctant to boost credit as banks lending to each other, if you can imagine, and housing sales remain weak. After loan growth weakened in April to the worst level in almost 5 years, several indicators suggest data for May won't be much better. Housing sales have continued to slump, indicating a lack of appetite for mortgages and subdued credit demand among developers and sectors linked to the property industry. Struggling to find enough clients, banks have been swapping bills with each other just so they can meet regulatory requirements for corporate lending. I mean, this is ridiculous that banks are swapping bills. It's like they're doing transactions with each other just to show that there's volume and that they're meeting the regulatory requirements. And you know the system's in bad shape when that's what bankers have to resort to doing. Let's continue on. As reluctance to borrow stems in large part from the uncertainty over China's COVID curbs and whether future outbreaks could lead to repeated lockdowns like the one that crippled activity in Shanghai for weeks. Businesses had to halt production and cut jobs, revenue slumped, and profits have plunged, and many companies are putting expansion plans on hold. And this is what happens in a debt-based economy. When people, consumers, businesses, when they lose confidence, well, they stop borrowing, because what the system needs is people to remain confident that the future is better than the present. And when the future is going to be better, well, then it means you can borrow now, buy that house you want, get that car you want, expand your business to meet the demand for goods and services that your company offers, and that all leads to increased lending. But when demand falls, all those things go out of the way and the system starts to crumble. Let's continue on. As the sluggish credit demand points to worsening expectations among market entities and slowing business expansion. This suggests that China's economic rebound might be weak even in the third quarter, meaning this is going to go on even longer, as many investment activities can only start after loans are secured. The scenario is a challenging one for policymakers who are pushing banks to lend even more. And the People's Bank of China told lenders last week to go all out in increasing loans. It also pushed banks to lower mortgage rates and called on them to stabilize lending in the property sector. But this is a challenge, because people don't immediately turn around and go out and borrow and buy a home just because rates fall. And a lot of people believe that, particularly here in the U.S. Well, if rates come down, Steve, don't you get it? People are going to flood out in the housing market. It's not how it always works. When people have given up on that hope or dream or desire to do something, they move on to something else. So just because rates might drop a little bit, at least in China or here in the US at some point, doesn't mean that all of a sudden there's going to be a flurry of activity of people buying. The upshot is the financial system was awash with cash, and any monetary easing from the central bank, which we'll get into a little bit later in today's show, such as interest rate cuts and liquidity injections, will likely prove less effective in spurring growth in the economy. And what this is suggesting is that because there's already so much cash in the system, that if you lower rates even more, it doesn't mean that people are going to go out and borrow. What the problem is, there's so much cash in the system that people don't want to borrow it now. They're just sitting on cash, and that's where you start to get into the concept of liquidity trap, which we'll get into a little more deeper here in a bit. But I want you to compare and contrast what China's doing with what's going on in the U.S., because we face a similar problem. We're just going to solve it a different way. And here you can see in the U.S. we have this overnight reverse repurchase agreements, and these are money market funds that are going to the Fed on an overnight basis because of the collateral shortage. This is something that Jeff Snyder, our friend, has talked about extensively, is there's not enough T-bills in the system. But what's happening is these money market funds, to the tune of over $2 trillion a night, are going to the Fed to get collateral. In exchange, the Fed's paying them an interest rate, one that's so attractive that they're doing it, of 0.8%. Now you might be thinking, well, I'm not getting that high of a rate on my money market fund. Well, of course you're not. But the money market funds know, because there's so much cash, they don't have to offer you a higher rate. They can scalp the difference on what the Fed's paying and what you're willing to accept. And that's at least what's going on here in the U.S. Now, the Fed's response to that is a little bit different. Of course, when we see China looking to ease, we see the Fed looking to tighten. We'll get into that here more in a bit, but let's continue with the story in China, as falling rates on a type of short-term intrabank loan is one sign that banks aren't lending too much to corporates, so they can't even get loans out to corporations. The interest rate on transferring bankers' acceptances maturing 1 month fell to 0.01% early last week. And what that is, again, a sign that there's too much cash in the system and not enough demand, so rates fall. That's really important. So in the US, we have this perception that there's a lot of demand, but we do have a lot of cash. Wait till that demand falls. What are you going to see interest rates do? That's right, they're going to head lower. That's the fourth time since December that the rate approached zero toward the end of the month, according to data from Shanghai Commercial Paper Exchange, as purchases of the bills are counted as loans to companies. So a rate near zero means buying banks are asking for almost no discounts on those purchases as they try to meet regulators' requirements to lend even more as firms refuse to borrow. And companies aren't interested in selling debt either. The amount of onshore corporate bonds issued is set to fall behind the value of maturity for the first time in 7 months in May by 102 billion yuan. That means more debt was repaid than borrowed. And in a debt-based system, that's the worst thing that can happen. You need a constant expansion of debt. And as that debt expands, the economy expands. So as debt gets repaid faster than new loans are coming out, that means the economy is contracting. So we know right now that China's economy is starting to contract and shouldn't be much of a surprise. As authorities have taken more concerted steps to spur borrowing in the property market, the PBOC cut mortgage rates by a record this month, and banks reduced their 5-year lending rate, resulting in a reduction in home loan rates by as much as 35 basis points or 0.35%. Authorities have also said they would support reasonable housing needs as more cities are easing curbs on home purchases by lowering mortgages, allowing people from other cities to buy homes or taking other approaches. And it wasn't long ago we talked about how China wanted to curb speculation, and now it seems like, hey, will somebody please come buy a home? We don't care who or where you're from, just come please buy a home. Much different story now that the tide has changed in their economy. Housing demand is hard to boost immediately as buyers are unsure whether developers can deliver on the projects on schedule, whether home prices are dropped, and if they'll be able to continue repaying their mortgage. The resurgence of the outbreak has dampened residents' expectations of stable income. And again, this is a confidence story. When people lose confidence in the economy, the housing market, you name it, the demand starts to fall, and these companies who are heavily leveraged in debt or spec homes perhaps, well, they start to run into problems too. The banking system is brimming with cash. The overnight repurchase rate, the main gauge of intrabank borrowing costs, has stayed under 2% for more than 2 months, the longest stretch in 2 years. And in last week's meeting, the central bank and banking regulator ratcheted up their calls for lenders to boost loans, telling big financial institutions to shoulder their responsibilities, make use of all resources to effectively connect with credit demand, and strengthen policy transmission, because what they're afraid of is causing a liquidity trap. Now, you might say, Steve, I don't know what a liquidity trap is. No problem. Check this out. Liquidity trap is contradictory economic situation with interest rates are very low and savings rates are very high. Think the U.S. right now, rendering monetary policy ineffective. Now, what that means is as central banks ease, it has no effect. So I want you to think about that as we get into the latter part of the story today. But look at what this Fed is doing, the opposite. So instead of easing, the Fed now is tightening. Well, there's a reason why. So first, as described by economist John Maynard Keynes, during a liquidity trap, consumers choose to avoid bonds, sound familiar here in the U.S., and keep their funds in cash because of the prevailing belief that interest rates could soon rise, even though they don't, which would push bond prices down. Because bonds have an inverse relationship to interest rates, many consumers do not want to hold an asset where the price is expected to decline. At the same time, central bank efforts to spur economic activity are hampered as they're unable to lower interest rates further to incentivize investors and consumers. And that's really part of the issue here, is when demand starts to fall and consumers start to lose confidence, what central banks do is they lower policy rate. They lower interest rates, they ease financial conditions to get people to borrow and consume now instead of down the future. And when consumers don't respond to that, well, it neutralizes the effect of monetary policy. So how do you get out of a liquidity trap? Well, that's a good question. Now, a central bank can raise interest rates, so we see the Federal Reserve doing that, which may lead people to invest more of their money rather than hoard it, meaning get it out of the banks and into the financial system. This may not work, but it's a solution. A key note that it may not work. A big drop in prices or deflationary crash, and when this happens, people can't just help themselves from spending money. The lure of lower prices becomes too attractive, and savings are used to take advantage of those low prices. And this is one thing we talked about, is the Fed wants to crash the economy. And people say, well, that's not what they want. It works. If you've got $2 trillion sitting in money markets going nowhere that you're backstopping, and prices come crashing down, you solve two problems at once. The economy comes down, prices come down, money floods out of money markets, and then you spur the next growth cycle. And if you can do it quick enough, the system actually works. Because the Fed is facing the same problem with liquidity trap, neutralizing monetary policy. So they have to raise rates here, and they have to hope it works. And the last step is you can increase government spending. Now here in the U.S., with Congress stonewalling spending plans, that's not going to happen, particularly with high inflation. And when the government does so, it implies that the government is committed and confident in the national economy. This tactic also fuels job growth. So you can see the implications of the liquidity trap are really serious here. The Fed's trying to avoid one while China's trying to create one. If you're concerned at all what a deflationary crash could mean to the stock market in your portfolio, well, you shouldn't be. I'll put a link up here to Portfolio Shield in the corner and the description below. You'll be glad you did. And now you're about to be shocked at what China's response to all this is. Or maybe you just won't be that surprised at all. China's leans on policy banks to deliver $120 billion in stimulus, as funding could help finance a chunk of infrastructure costs. So they're choosing option number 3, which is to spend more money rather than raise rates. As the stimulus announced at a state council meeting chaired by Premier Li, could help finance a significant chunk of infrastructure costs this year and give some relief to local governments grappling with plunging revenues. And President Xi Jinping has called for an all-out effort to boost infrastructure this year, turning to an old playbook of driving growth through public investment. And funding the extra spending has proven to be tricky, though, after a plunge in land sales and widespread COVID outbreaks battered the government revenue. And I want you to understand that they're hoping this works. They don't know, and if it doesn't, well, that means there's a deflationary crash coming to China, as they're going to be forced to raise rates. And we think the key ingredients for investment projects, financing, and incentive are all falling into place this year. The additional 800 billion yuan loans from policy banks will help fill the financing gap, if any. And Beijing's call for a faster implementation of growth-boosting policies have intensified since official data showed the economic activity contracted in April and unemployment rose sharply. High-frequency indicators suggest the decline continued in May, leading Li to warn last week the risk for a possible year-on-year contraction in the second quarter. And the State Council didn't say in its latest announcement how the policy banks would fund the lending. They don't actually know. The development bank's main source of funds come from issuing bonds or loans from China's central bank. And as we've seen with cash flooding China's banks, people don't want bonds. And as we know in the U.S., people right now don't want bonds. Of course, they don't want them now, but they will at some point in the future in droves. But that is a story for another day, as the banks may be able to raise the money by selling bonds, likely long-term one with tenors of 5, 10, or 20 years, to fund an expansion of credit. And the People's Bank of China could cut the reserve requirement ratio, again, more policy easing, or the amount of money banks have to keep in reserve by another 50 basis points to support the financial market with liquidity. So as you can see, the situation in China is indeed bad as they face a liquidity trap. The U.S. faces one too. They're both handling it different. The question is, will one succeed over the other, or will they both fail in different ways? Well, I guess we'll stay tuned, because the outcome could be quite interesting. I'm your host, Steven Van Metre. Thanks for watching. Thanks for being fans. Bye now.